first, before you begin trading, before you begin putting money into the market, you need a written plan. But first, you need a strategy as well too. So what I suggest you do is, with the strategy that you're learning, with the concepts that you're learning, whether it be a course, whether it be from YouTube, whether it's a book, whatever it is that you're reading, whatever you find that you like, we're going to put that into a simple format. But first, let's start with currency pairs. So when it comes to currency pairs, I mean, we have so many. So what you want to do is categorize your currency pairs. You have your majors, you have your minors, you have your exotics, but you also have other financial markets such as cryptocurrency, where there may be Bitcoin, Ethereum, Litecoin, maybe even Ripple, and other more. And then you have the stock market, Apple, Microsoft, Nvidia, all of those. Then you have indices, the dollar index, US 30, NASDAQ 100, XPX5. But whatever the case is, when it comes to Forex, you want to look at the categories. Let's just start with the majors. So there are several major currency pairs: AU, EU, NU, GU, USD CAD, USD Swiss, USD JPY. I think as a beginner trader, you may want to start looking at all seven. And the reason why you want to start to look at all seven is because you want to get used to how each currency pair moves, because they don't all move alike, but some of them do move similar, such as AUD USD, Euro USD, New Zealand dollar, and pound dollar. They're what we call correlated currency pairs, because even though they may not move together candlestick by candlestick, they have a really good consistent flow together. So if one is going up, there may be another one within that group that is going up as well, and you compare those together. But here's a good rule of thumb: choose one or two out of those seven currency pairs to trade. One of the reasons is you don't want to get overwhelmed with how many currency pairs you're trading. You don't want to get overwhelmed with similar like currency pairs. You want to pick the best one that's going to really resonate with you. So that's really important there. Now, when it comes to your minor currency pairs, these are currency pairs that do not involve the United States dollar. When we look at the majors, all of them have the United States dollar in common, but minors are pairs like pound JPY, AUD CAD, New Zealand dollar Swiss. If you hear the names, they don't involve USD or United States dollar. And those can be really good to trade, because when the dollar is being volatile or when there's major news coming out, those minor currency pairs don't get hit as hard as the major currency pairs do, or any other pair or instrument that involves the United States dollar. So it's good to have a few of those in the bag as well. So when you're creating what is called a watch list, you're just going to start with writing out what major currency pairs you're looking at, what minor currency pairs you're looking at, and what few other financial instruments you're looking at. Now, you can just stick with the Forex market if you want. It's a really good market, or you can mix and match. So that's the first thing you're going to be doing in your beginner trading plan. So now that you have your currency pairs all chosen out, let's go into your strategy. What is the foundation that you trade? And there are so many foundations, but there are just a few frameworks. So your framework is basically the priority you trade, such as support or resistance, supply and demand. That can be in the form of levels or zones. You could do quarter points, you could do chart patterns, you can even have trend lines. It's important that you choose just one, your main focus. One of the things that I see a lot of traders get mixed up in is they try to choose more than one as beginner traders, but they don't have a priority. So if, let's just say you're your support and resistance trader, or even a supply and demand trader, and you're using what's called zones. If price gets to one of your zones, but you also have a trend line, you're now forced to ask yourself, which one do I focus on first and which one comes later? But what happens if you also trade what's called a break of structure? What if price breaks the zone? Then where does that leave your trend line? Are you then trading the trend line? Are you also waiting for the break of the trend line? Now you have too many questions to answer, and it's not really supporting your trade idea, and the trade could just get away from you. So if this has been you, with this workbook, the first thing you're doing is you're writing out the foundation that you're trading and why is that your priority. Now, what you also want to do is write down what is the impact that it will have on you. For example, I am a supply and demand trader, but I don't trade zones the way most people trade them. I use what's called my estimation zone. It's still a zone, but what I am personally doing is I am estimating the best price I can buy or sell a financial instrument. And that's it. I'm only focused on my one understanding of my supply and demand strategy, my one entry, and how it impacts me, because it makes it easier for me to see my trade. It makes it easier for me to see my one entry. That's the impact it has on me. So whatever yours has on you, you want to write that down in the understanding of what it is that you're trading. Because if the understanding is too complicated, the impact won't be as successful as you need it to be. The next thing we're going to do is write down your time frames. I suggest you trade 2 time frames at a time. One of the reasons why this can help you is because if you just focus on 2 time frames, once again, you're dialing down the confusion when it comes to multiple time frame analysis. So your first time frame should be everything inclusive. It should be the time frame where you view the trend. It should be the time frame where you're taking your strategy, the tools you're using, and what you're plotting, and you're using it on that one time frame to find where you're going to enter the trade, where you're going to exit the trade, and where you're going to place your stop loss. That way, if you need to drop down, this is the second time frame, if you need to drop down to get a better entry, you've already done all the work on the first time frame. So write those 2 time frames down in this workbook. The next thing we're going to focus on is your trading style. Now, this is really important. You don't have to niche down right now in your trading style, but it will be good to niche down and then to find what supports that trading style. For example, my trading style is swing trading. I can hold the trade for more than 24 hours, sometimes at most more than a week, a month, or 2 or 3 months if I really need to. But that's because I asked this one simple question. Well, technically it's 2, but how often do I want to show up to trade, and do I need the money like by tomorrow? So I don't want to show up every single day to trade, which means I'm not a day trader and I am not a scalper. So I also know how long I want to hold trades for, which can be a day, it can turn into a week, it can turn into a few weeks, it can turn into a few months. But honestly, that's based on my strategy and the time frames that I am using, right? My top 2 higher time frames. So now what I do is create a trading schedule based around my style in those 2 questions. I analyze my charts every single Sunday, and I set up my trades on Sundays. That way they can run for me. And if I have to come in and maybe set up a chart again because something has moved, that means I just have to update it. I can do it very quickly within under a minute because all the analysis was already done on Sunday. But then I have to ask myself, well, how many trades do I need every week? 1 to 2 trades for me can be good. If I get up to anything more than 5, I know I'm over trading. But that's because, remember, I am holding my trades and I don't have as many trades on one currency pair every single day or every single week because of how long I hold the trades and then how long the trades have to set up for. But you may be different. You may be a person who's using the 1 hour and the 15-minute, which means when you're using the 1 hour time frame, you're gonna have a trade maybe every day or maybe every other day. So your trades are going to come quicker. So estimate how many trades in that week do you need to be successful and let it support it if you're a day trader. But then think about your schedule. When can you successfully focus on your charts? Would it be in the morning for 1 or 2 hours? Would it be in the afternoon for 1 hour? Would it be in the evening? I typically find that for most day traders, you only need less than 30 minutes a day to find a really good trade and to let it run until it hits your target profit or your stop loss. Anything more than that, you may be over trading. And if you're a scalper, you're a little bit more streamlined, which basically means you have to focus and stay on your charts. Maybe you're a person who can afford to trade 1 to 3 hours a day and you're looking for your 1 or 2 setups. Then if that's you, then hey, your 1 or 2 setups can be good for the day. Even have a rule that says if you lose more than this number of trades in one day, you're going to be done. And I find that that's more helpful for scalpers. Now here comes the really fun part that I really like. And that is actually putting everything together in action steps. The first thing that you want to do with time frame number one, what you want to do is write down your very first time frame. And you're going to write down the actions that you take on that one time frame. The steps may be you go to your computer and you go exactly to your first time frame, and when you're on that time frame, you may look for this, you may plot this, you do this, and you do that. I really do suggest that you try to keep it down to 1 to 2 actions, but make those as detailed as possible. So for example, you could be a person who says that I trade trend lines. And if you're a person who trades trend lines, you could say, well, I look for the trend, I look for price in the uptrend or a downtrend, and then I plot my trend lines on the last 2 or 3 lower lows and lower highs, or higher highs and higher lows, depending on the direction of price. Then what you may be looking for in action 2 is you're looking for a break in a retest or a rejection of your trend line, and then you're done on the very first time frame. Next, what you want to go to is the second time frame. And remember, this time frame is for your entries only. So you could be saying, well, I'll drop down to this time frame. Remember, that's your second time frame, and you're looking for a certain candlestick rejection or pattern within the realm of your trend line in order for you to enter a trade, and then you're done. If you can literally keep it that simple, my gosh, trading can really be amazing for you. You don't want to just stop here. You also want to have rules for your take profit and your stop loss, meaning you want your take profit to have the same rules as what your stop loss would have. Let's just say you're a person who you swing trade. We're going to go back to the trend line analogy. And when you get into a trade, you may put your stop loss, let's just say 30 pips below your entry every single time. But you want to make sure that that is a consistent rule that you can follow depending on the market and currency pair that you're using, because it might change up, right? There's nothing wrong with changing things, but you still want to keep some sort of consistency. And then where you put your take profit, you want that to be consistent as well. If you're trading from a higher trend line, maybe you take the trade back down to a lower trend line, but let that be a consistent rule and only change it when you need to, but still show consistency. Last but not least, you do want to have a rule for the minimum reward to risk trade that you're willing to take. Meaning, if you're a person who wants to always see more profit than your risk, then you could say, well, I don't want to take any trades that's less than a 3-to-1 reward to risk. And what this means is that you're always going to 3 times what you're willing to risk in your trade. This way, you know, if you maybe lose a trade, you only lose a small portion of your account, but when you win, you'll always win 2 to 3 times more than that, and sometimes 4 and 5 and 6. It's just the minimum that you're willing to take before you enter a trade, or those trades are subpar and you won't take those trades that's less than a 3-to-1. So in this workbook, I've also included some examples of how you could actually trade and create your template, and I pray that it works for you. And if this does help you and you see the value in it, be sure to hit me up over on Instagram. Make sure you guys tag me when you start to use these workbooks, so that way I can share it, and then we can get more people on this simple workbook for beginners just like you as well, and just share the love, the knowledge, and the wealth. And also, if you do need help with your trading plan, if you find you need more out of your trading plan, maybe you have some missing pieces, you don't know how to work them in, and you would like to back test your trading plan, be sure to book a one-on-one with me where I can help you build your top tier master trading plan. I'll talk to you guys in the future. You guys be blessed. Safe trading.